All right. What's up, Security Token Market family and Arca family? We are back again with episode 6 of our 6-part series, Tokenization for Institutions, What You Need to Know. And this is sadly our last episode, but hopefully not the last, because this is the last of the 6 that we've organized together. But the goal of this series, as a reminder, is to usher in the tokenization playbook to institutions across the map, as tokenization is one of the more under the radar verticals within digital assets to date. Last episode, we had an amazing discussion. We discussed growth with tokenization industry and parallels to the ETF world with Arca's CEO, Rain Steinberg. In this episode, we will be focused more on product structuring and active cases to reference. We're joined by Arca's head of growth, Anthony Bufinsky. Welcome, Anthony.
Thanks so much for having me. Appreciate it, guys.
Absolutely. So I'm just going to introduce myself and we can get right into it. I'm Jonah Schulman, head of comms and security token market. Before joining STM, I had experience working in the TradeFi space at Deloitte, Bank of America Merrill Lynch, and an endowment fund, while at the same time I was working for a blockchain firm as an advisor. Through this, I learned about the powers of blockchain technology and how it can be applied to finance and TradeFi products, which we'll dive into today. As a quick reminder, STM is a leading provider of security token data and research. We track over 200 plus tokenized assets totaling over 18 billion in secondary market cap. In fact, the market cap was only 1 billion at the start of the year, so it's been amazing to watch the secondary market exponentially rise. Peter?
Awesome. Thank you, Jonah. And I'm Peter Gaffney, head of research at Security Token Advisors, our advisory and consulting arm, actually. There we kind of map out the industry, connect the ecosystem as it is quite fragmented across all the tech partners, legal groups, transfer agents, ATSs, you name it, on behalf of our clients, ranging from pre-IPO shares to private equity firms to private funds, private credit, et cetera, et cetera. I spent some time at a boutique private equity firm and Global X ETFs prior to this. Figured let's marry those two together, and that's tokenization in a nutshell. We rely heavily on industry partners to do what we're doing. So on that note, Anthony, would love to get your side of the story here.
Sure, I appreciate it. So Anthony Bufinsky, 25 years of capital markets experience, the past 5 years exclusively just in digital assets. So I'm head of growth here at Arca Labs. Arca is an asset manager focused exclusively on digital assets, digital asset ecosystem. We're bifurcated into 2 registered investment advisors, one being our private funds group, that's our hedge fund, NFT, as well as venture fund. And then my group, Arca Labs, focuses on innovation, advising issuers on token structuring and issuance, as well as administration.
Fantastic. That's great to hear. And, hopping right into it, let's look at what the market's, showing us these days in tokenization. So the secondary market cap is about $20 billion based on what, we track on STM side, but we on the advisory side focus more on the primary side, kind of been estimating that around like $70 to $80 billion, including, let's say, assets that have been securitized on the blockchain. I think of like Figure Technologies, Providence blockchain, and doing HELOCs and kind of mortgage-backed securities, capital raises, assets that have actually been identified and located for tokenization, and of course, pre-existing bonds and products across like corporations, government entities, and kind of things even from the 2018 through 2020 days. So what I'm pretty curious in is, Anthony, what types of products are you looking at now that you think the market needs, right? We've seen a handful of kind of retail-driven products, but what is really needed to unlock the institutional capacity here?
Yeah, sure. So we're starting to see a lot more activity in regards to, international markets, as well as local markets. What I'm starting to see is more, investments such as curated project loans and infrastructure assets, and we'll get deeper into that. That's a massive market. Receivables, municipal bonds, that's creeping up again, as well as rehypothecated assets, right? So for me, one of the largest asset classes that is underserved right now, and really there's a gravitation towards real world assets, right, in our industry. If I can do an actual DCF calculation, have recourse back to an asset, understand the rules and regs in regards to where that is, that's really compelling. So in infrastructure assets, it's a multi-trillion-dollar asset class, right? Typically QIBs, large banks, pension funds, insurance companies like these types of assets. Why? Because they match their ALM capability in regards to their long tail. There's once again, a real asset that's tangible there. So here at Arca, we're aligning with a lot of the largest multilateral development banks, right? And how do we create, a marketplace in regards to attracting foreign direct investment? These multilateral development banks have a mandate in regards that they have fiscal and non-fiscal KPI mandates. This is for GDP and subsector GDP kind of roles and initiatives. So, to create, a foreign direct investment opportunity in a location outside the US that's attractive in regards to yield, and has real, teeth in the deal in regards to that, there's enforceability on an asset, it's cash flowing. This creates a really compelling, atmosphere and ecosystem in regards for issuance. So ESG components have been kind of the talk as of late, I think even in all markets, right? The ability to go ahead and create, those types of instruments in a tokenized format, create a marketplace, create liquidity by inviting partners, right, at large scale, right? This is fully scalable out to multiple jurisdictions, and have a real trading environment for price discovery. To me, this is really creating what I call economic transformative type technology, right? That's applicable via blockchain. Now we can have tradability, traceability, and trackability of assets out in the field. And this, like I said, is really kind of gravitating towards real world asset issuers. So I see that as kind of the next level and in regards to like a massive opportunity, right, at the global level. Also rehypothecated assets, right? If you have private credit funds and or let's say issuers in the private side want to issue a private debt, the ability to go ahead and rehypothecate, let's say the IO, the interest only strip, and have an arbitrage opportunity to subsequent and or substitute that, reconstitute it with, let's say, a treasury strip, like a REMIC, a TIP, etc. That's becoming, more, I'm getting more inbound on that, right? So the flexibility, and this is so, transcends what 2008 was, right? When we had collateral out in the field, was lent 2, 3, 4 times down the chain. In this case, by having, blockchain and immutable ledger to track that collateral out in the field, that definitely brings an arbitrage opportunity for issuers, hedge funds alike, et cetera, to go ahead and, create these securities, strip them out, and then, create other arbitrage opportunities to go ahead and purchase out in the market. So a lot of fun stuff. We're seeing municipal bonds as well. The ability to go ahead and, these are typically $5,000 and $10,000 lots, right? For me, I'd love to invest in my backyard. I always say, I live in a great city. How do I do that? And the only way I get that kind of accessibility is through an ETF or a mutual fund. The ability now to get that at a more granular level, have a city finance manager, as an example, go out and issue a bond, non-certificated, but obviously in a blockchain format, set up wallets for constituents at the local community, and then also have that interaction, right? That socioeconomic development, interaction with investors at the end of the day, at the localized level, and see actual tangible improvement. That's a really compelling notion. So I know that's a lot to unpack, but we are seeing this now go more mainstream and being more digestible to a larger audience, which we need, right? We have to go outside the institutions, look at retail as well, and then look at the global scale in regards to attracting, investment opportunities for tokenized issuers.
Wow, very well said. It's, like you said, a lot to unpack. You said something real quick that kind of stood out to me that I like. We know the fractionalization to lower buy-ins, to make funds more accessible. We already kind of know that's the case, right? But you even mentioned the recourse benefits. I feel like one thing that kind of limits tokenization right now is that a lot of institutions and more sophisticated investors always have to have some form of power, right, over their position. They need to be in control. How do you think the recourse benefits affect that, and then can that be done on chain, or that be more off chain? I think that's a key piece here, depending on the investment type. So we'd love to hear your thoughts on that.
It's a great question. So the legal aspect obviously always comes up, right? And how do we go ahead and normalize a traditional investment, and obviously have recourse back to that. And I think we're there in many cases, right? We can do that on chain. We're seeing this, in other areas, let's say even like insurance, right? As another one where we do on-chain policies. More progressive jurisdictions are starting to adhere to that, and create that, let's say, legal framework and regulation, so we can adopt that and give the optionality for investors to come in. Once again, it's all about getting investors comfortable that this is we're not reinventing, we're essentially reinventing the wheel to some degree, but it's very traditional in many cases to a book entry security, right? Where to have an indenture, governed by, and have, a trustee, et cetera, to give enforceability in regards to default. I mean, to me, having kind of the hybrid of the traditional trustee, but look at the paying agent, registrar, transfer agent, capability on the blockchain as the real kind of secret sauce for, making this more expeditious, but still having the legal doc in regards to a smart contract, right? And having any kind of remedies, enforcements that can be kind of, obviously curtailed out in the field, have, bondholders, creditors, equity, whatever it's going to be, have, voting power and rights. From a legal perspective, to bake that into a smart contract and have interoperability for assets. To me, like I said, we're there. We're getting there. Let's put it like that. It's a matter of who's going to tip their toe in the water first, right? And that's kind of where we're at in a lot of these cases. But the technology's there. The legal framework in many cases is there already. It's, like I said, it's just having those first-time issuers, obviously gravitate towards this kind of packaging for their investors to participate.
Absolutely. In terms of names, Jonah, what are we thinking?
Yeah, I mean, you was a perfect segue. So in terms of, tipping our toes in water, I think KKR even went, straight to the deep end. I mean, you guys were technically first, right? You tokenized the first 40 Act fund. They did something a little bit different, where KKR tokenized a feeder fund of I think it's the health, of a bigger fund, the healthcare growth equity fund, or I believe it's called something like that. But KKR, obviously, as we know, is one of the largest private equity firms in the world, 471 billion AUM. This is huge news because they're, a financial incumbent. They're very conservative, and them to make an announcement like this, to me, sends ripples throughout the industry in the world. Like, tokenization is not a joke. Crypto is one thing, NFTs are one thing, DAOs are one thing. Yeah, there's a lot of innovation there, but tokenizing real world assets and real world, fund products to allow more people to get involved is fascinating. And I wanted to hear your thoughts on, so what they did, just for the viewers, is they tokenized a feeder fund to enable more access to it. So traditionally, either ultra high net worth individuals or institutions usually would have access to the fund itself, but they created a feeder fund to allow qualified purchasers, which is basically someone who has 5 million in investable assets. And I believe the minimum investment amount is 100,000. And my thoughts around that is like, that's great. So I believe 2 million people in the US qualify under that investor specification or requirement. Why did they not just bring it down to accredited, and why did they keep it at 100,000 minimum investment? Why not bring it to 10,000? What do you think about that, what they did?
Sure. I mean, for me, we have to break this barrier of, let's say, of the higher denomination, down to a more digestible component. So to me, that's a barrier in our industry right now, right? Different fund managers have different kind of, let's say, mandates in regards that they may already have, a pool of investors, right, that fit that criteria, and they have that distribution, let's say, covered per se. But to me, that is a bottleneck in our industry, right? We have the capability and technology to go ahead and lower the limits, and do smaller denominated offerings, increase participation. So to me, that's something that needs to change and hopefully will. In regards to, let's say, the private equity, and let's say VC firms, doing this, hey, it makes perfect sense in many factors. One, like I said, it's path of liquidity, right? By having this optionality in what's a digital twin in regards to, a tokenized portion of a fund makes perfect sense. I see this in, let's say, commercial real estate, right? Where, let's say, a pension fund has an iconic asset right on their books. They don't want to kind of part ways with it, right? But they want liquidity. To tokenize that portion and sell that to a minority investor, a minority interest investor, that makes a lot of sense, right? And they still keep that asset on the books, still keep control. But once again, it's also a service to their investors too, from a fund level, because like I said, you do bring this liquidity as well as price discovery, right? And in many cases, not many cases, but in some cases, we've actually seen, the tokenized portion actually, have higher accretion in regards to value, right? And that's where we want to go. We want to have the ability to have liquidity in the system when there's high volatility compression, price discovery, and then make that asset more, valued from a mark to market versus mark to value, right? Because these are hard assets to value. It's expensive in many cases. So let the market dictate that, right? In regards to liquidity, because otherwise it's a quarterly valuation on real estate, appraisals. That takes time, cost, money. In this case, you could have a secondary, tertiary market by offering this digital twin and have liquidity. And then, like I said, that's a service back to your investor base, right? And it's an option at their volition to take. Would they choose not to participate or participate, up to them. But once again, it gives further fungibility in regards to these funds. So to me, these are well-known names, obviously well-recognized, and that's what we do need. We need the brand equity from larger players to go out there and give confidence back to, let's say people that are kind of pondering, this type of investment.
Like, should we not?
Exactly.
Yeah.
So it's typically the larger names that, will, ultimately jump in. And then that'll be the kind of the proof of concept. And then we'll see. So we're going to see more of this. There's no doubt. Obviously the volatility in the markets. So today we're down 500, we're up 600 points in the Dow. It's going to be a lot of headwinds going forward. Liquidity is everything in times of, high vol. So to me, like I said, having that as an indirect upside to investors is a key point.
It's huge. Yeah, absolutely. And just soon after, I think a week or two, we saw the announcement of the Hamilton Lane, another massive institution, started to tokenize, I believe, the same model, but 3 funds this time. And they're also a huge investor in ADX, which is a security token focused exchange in Singapore. So they invested about a year ago, I think, in that, and now they're tokenizing. That's exciting to see. I bet there's tons of, sure you see on your end, there's tons of institutions that are like, on the fence. They're not sure they're going to do this, but I really hope that Hamilton Lane and KKR have successful, getting investors in on this, and also having the secondary liquidity component, because that will prove that it works, and the brand equity will be there, as you mentioned, and it will prove that this is not only can you get more investors in the door, you can increase your AUM, you have a service to your investors and have secondary liquidity. Like, it's perfect.
Agreed. It's a win-win for all, ultimately, and it creates more transactions based, banks and funds, like transactions, etc. More movement in the system, I think, is healthy, right? But once again, bringing liquidity and price discovery to a very static market. That to me is, like I said, the kind of the holy grail where we want to be. So obviously the technology is there. Bring the legal perspective in, have that framework there. That's, like I said, that's where this market's going, and it will. There's definitely a pipeline of very large, well-known names that are now, obviously in the queue to do the same. So I have no doubt our market will grow exponentially as it has in a very quick fashion.
Absolutely. So let's talk about product structuring on that note, kind of. So a lot of what we've been doing at STA with our clients, typically private placements, right? We're really looking at the Reg Ds for the quickest to market to accredited investors, but also Reg As if you want to open up to retail. Could take anywhere from 8 months to probably 14 months at this rate right now with SEC dialogue. But you guys spent pretty much 2 years working out the BTF model. So I see the low-hanging fruit as the Reg D model. If you want to prove a concept, you can spend X amount. You could take 3 to 5 months, come to market, and then work to figure that out. As Jonah was just saying, raise the capital, which is the key here. We don't want to see marketing plays. We want to see real products that find buyers, right? And then list on ATSs. But are we thinking about that the wrong way? Maybe. Do you think institutions would rather use your model, perhaps, like the Arcoin model, or other 40 Act funds? Or what do you think is the most ideal play here? Because it's kind of limiting to only do private placements. We do want to move stuff to the public side, but it's kind of up in the air right now. So we'd love to hear the thoughts on that.
Yeah, I still think a standalone fund is still the simplest structure. Investors, subscribing to a single interest or single vehicle, right, with a parallel fund, both onshore, offshore, managed in the same and invest in the same parallel. We're starting to see also, segregated portfolio companies, right, SPCs, that are used, and they're exempted. They're an exempted company registered as an SPC. They're cost effective in the fact that they're umbrella-like, right? And the key to that is really looking at and identifying how to maximize the structure like that have, let's say a holding co and multiple cells under it. And the key here is when you have leverage on the system, right? What we want to be cautious in regards is contagion, right? In regards to having an entity that has multiple strategies, and especially, like I said, when leverage is involved, heavy volatility, that could go up and down, obviously, against you. So to ring fence that risk, I think, is really key. And that's, same thing for an insurance cap. It does the same thing for its, future claims and liabilities, right? It segregates that. So I'm a big fan of the segregated portfolio company as a structure. Also, exempted limited partnerships, right? ELPs, that's closed-end structure, right? That's another one that would be, to kind of look at. But the fund structure and the way it's set up to me is kind of paramount in regards to kind of being the, kind of the bones per se of the framework to go out. I'd love to see more Reg A plus transactions, Jobs Act kind of, issuance. I mean, to me, that's where we want to go. So we get smaller issuers into the marketplace, have accessibility, open and scale out their investor base, right? With this, with blockchain, and obviously, that to me is really kind of compelling, way forward. Just my 2 cents.
Absolutely. We have been seeing a noticeable increase in Reg A interest as well. Even clients who are saying, in the meantime, I'll do a Reg D, get initial capital from my accredited network, but the long-term vision is to file a coinciding Reg A. Waiting on the SEC dialogue, making sure you get approval, obviously, until we could open up to retail investors. I know Jonah's a pretty big fan of Rally Road's Reg A model with their Series LLC, and that's kind of a great model we've been looking at. I think that's great for, a number of assets. If you have kind of a uniform asset type and you just have one hold company that's issuing that. But yeah, just thinking about what's the most beneficial way at this, given the stage that things are right now in tokenization. And even you mentioned the LPs before. I feel like a bunch of them probably like the long-term vision of a secondary trading market on an ATS, but also at this point may even prefer an internal bulletin that's just powered by tokenization. Even if I have 20 LPs or something, I could even have 10 LPs, but if they can at least interact, that's also low-hanging fruit that could be enabled right off the bat, right?
Yeah, absolutely. Totally agree. I mean, for me right now, Reg D is kind of that's kind of the mainstream. To have a true bulletin board in regards to interaction from price discovery and trading, that again is high on my list. So like I said, to create these environments, for that, and they also create interaction in regards to, let's say, announcements from companies, things like that. It's not at the nominee. DTC is a very, opaque system, the way it is set up. You have a nominee, a broker dealer, et cetera, holding the assets. You really don't know who actually is the end user, right? You can essentially, maybe find out by calling the trading desk and things like that, especially when there's an exchange or consent proxy where I have to get 66 2/3. I have a 20-day period. These things are costly. The print, everything like that is expensive. The time. I've always been a fan of how do we get down to the beneficial level, and beneficial, holder level, to get better comms and corporate actions as we go forward. It just, like I said, increases, the fluidity in the system. You get things done in a more, expeditious manner, and the costs go down, right? Because the costs are expensive. And that's what's delineating a lot of the smaller issuers, right? To enter into market, when you have a traditional, underwriter involved. You have all these other third parties, not to say that they're bad, but they just take time and money, and they basically are acting as a barrier for many issuers to enter the market. So to go issuer direct right out to investors, to me, that's always been the right methodology. The key is to have the traceability and trackability of the assets and the transactions along the way. So there's no, obviously, it mitigates risk by having the interoperability of the rules and the rule set out in the field, and to call assets back if they go into the wrong, like let's say an accredited investor versus a quib, et cetera, whatever it's going to be. You could call that asset back in the field, and then burn it, and then obviously reissue.
Yeah, absolutely. There's also like solutions, and this is what's kind of cool about all the tech providers and the actual TAs that we're working with. Some of them are heavily on-chain focused, and they would claw it back and burn and reissue. Others are working with like API calls. So in the first place, check before a transaction is even made. That way, you don't even need the clawback, and it's going to be blocked right off the bat.
You bet.
That's stuff, yeah. It's also cool to see in these products you use like from an operational level, I'll call it. I like saying here's the product bucket, the operations bucket, right? And
Sure.
like, JP Morgan's been pretty active with their whole repo market, with their tokenized collateral network. Goldman with HQLAX been tokenizing a lot of money market funds for collateral management purposes. You guys with Artcoin is actually my entry to the collateral management side, thinking about tokenization from this operational level. So I think the last thought that I just wanted to leave with is kind of using even products for collateral management in the future, like muni bonds that are tokenized, real estate that's tokenized, whatever. Could that also be swapped around kind of like Artcoin did? And I think that would be like the unreal future, right?
It is, and it's definitely starting to happen. So for me, middle office is a key aspect here, right? So we have collateral slip during the day. Typically, we have middle office has to do mark-to-market valuation on assets, right? And in many cases, let's face it, DTC closes later in the day, typically 4 o'clock Eastern. If I don't have my trade order in, and I can't move collateral to another desk, let's say for an ISDA agreement, securities-based lending, et cetera, that's true collateral slip, and that's costly, right? So I could be under collateralized on an ISDA agreement when I have to be 103 over. What do I do in that case, right? There's covenants now. I've broken default, right? They can be remedied, et cetera, but you do have many cases, and this happens every day, of collateral slip within banks. So to be able to go ahead and mitigate that risk and be able to trade, off hours, to me, that's where, having a blockchain instrument is truly unique, right, and dynamic, and it has the same kind of, let's say, it's like I said, in our case, ruled as security, fits the investment criteria in regards to an agreement there. That's where it becomes very powerful to go ahead and kind of mitigate any risks in regards to collateral slip during a trading day, and then over the weekend, right? So having that 24/7, 365 kind of tradability, to me, that's where these banks should adopt.
Sure. And that's applicable to banks, asset managers, trading firms, kind of anything. So that's the all-encompassing answer right there.
Love it. Yeah, I think it's safe to say we're all in the right industry. We're advancing fast, and I love the tokenization, as you were mentioning, both of you, is just the optionality that it comes with. Like, you can just do so many different things that you weren't able to do before. Like, you can, the secondary liquidity, as you say, covering your collateral positions after hours, saving so much money in that regard is amazing. But I think we're coming to the close here. I don't know if you guys have any closing thoughts before we finish up this last episode.
No, I think from my perspective, like I said, I'm out in the field talking to issuers, big banks, at the local level and global level. Real world assets are definitely, high on the list in regards to appetite right now, both greenfield and brownfield issuance, right? So to me, that is kind of our next genre, and these are very large asset classes that I've mentioned. So I believe definitely within Q4 and 2023, we'll see some very large, brand equity type players out there that are well known, well established, adhere to this, so they can meet their internal KPIs, as well as give more optionality to their investors and shareholders at the end of the day. And so the market's definitely advancing. There's no doubt. There's no look back period at this point. We are going forward.
Point of no return.
Absolutely.
Yeah, the point of no return. I mean, KKR can't be wrong right now, right? That wouldn't look too good.
I agree.
Sure, that's true. I also think, as a final thought, I think a lot of the Reg D issuances that have been working behind the scenes over the past year, the past 18 months, may come to ATS listings in Q1 of next year. So I think that cascading effect on the secondary market will be quite noticeable by any traditional finance firms and investors in general, which is the key piece here, right? Finding buyers.
Agreed.
Absolutely. Well, that sadly wraps up our sixth and final episode in this series. Thank you so much for coming on, Anthony. It was a pleasure to have you. If you guys want to watch any of the other episodes, it's on our YouTube under the playlist Security Token Market and Arca. And yeah, thanks so much to Arca and to Anthony for coming on. It's been a pleasure.
Thanks so much. Really appreciate the time.